Hello and welcome to AI Market News by LM. A quick disclaimer before we begin. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, with that out of the way, let's get into it. Something really interesting is happening at the very top of the global financial system. A major split is opening up between the world's two most powerful central banks. We're talking about the US Federal Reserve and the European Central Bank. They're starting to head in totally opposite directions. So let's unpack what's going on and what it really signals for all of us.
And this quote from Fed Chair Jerome Powell, it really just nails the problem they're all facing. Central bankers are totally caught between a rock and a hard place. They're trying to wrestle inflation down, but without sending the job market into a tailspin. It's like a high wire act with absolutely no safety net. And as we're about to see, different bankers are choosing very different ways to try and keep their balance.
So, before we can get into why they're making these different choices, we kind of have to see the world through their eyes. And right now, the global economic dashboard is just flashing a lot of confusing, conflicting signals. So let's take a quick spin around the globe and look at the data that's probably keeping these policymakers up at night.
First stop, Europe.
And wow.
This number, it's a big one. It represents Germany's GDP growth in the third quarter of 2025. And yep, that's a negative sign, a contraction of 0.2%. When the traditional powerhouse of the entire European economy is actually shrinking, well, that's a massive warning sign for the whole continent.
Okay, now let's hop over to Asia. What we're looking at here is China's latest Purchasing Managers Index, or PMI. It's sitting at exactly 50.0. In the world of economics, 50 is kind of the magic number. Anything above it means the economy is growing, anything below means it's shrinking. So, 50.0, it basically tells us the world's second largest economy has, well, it's pretty much stalled out.
And this chart here, showing Japanese retail sales, this really just completes the picture for us. We can see a dip here too. Consumers are getting hesitant, they're holding on to their wallets instead of spending freely. So when we put all these pieces together, a shrinking Germany, a stalled out China, and super cautious Japanese consumers, we get a picture of a global economy that's feeling pretty fragile and uncertain.
And this global slowdown, it creates this massive headache for every single policymaker. It's the classic tug of war, right? Do you focus on fighting inflation, which is still stubbornly high? Or do you switch gears and try to kickstart the economy to avoid a recession and protect jobs?
This table just lays out the dilemma perfectly. On the left, we've got the US, and on the right, the Eurozone. Look at that top row. Inflation in both places is still hanging out above that 2% target they're aiming for. But now, look at the bottom row. Growth is looking, well, pretty weak. The US managed 1.6% in the first half of the year, while the Eurozone barely grew at all, just 0.2% in the third quarter. So the key thing here is both economies are dealing with the same fundamental problem.
But this is where their stories really start to diverge. This is ECB President Christine Lagarde. Her tone is one of, well, cautious optimism. She's acknowledging the tough global situation, but she's also pointing to what she sees as real strengths in the Eurozone. A strong job market, healthy companies. She's basically suggesting the economy can tough it out.
Over in the US, however, the mood is a little different. A lot more anxious, actually. While the ECB is talking up resilience, the Federal Reserve is looking at the American job market and seeing some cracks. They're seeing signs of cooling, of demand softening, and they're getting more and more worried that the main pillar of the US economy might be starting to wobble.
And right there, that's what's leading us to this great divide. You've got two of the most powerful financial institutions on the planet, looking at very similar global problems, and they are about to set off on two completely different paths.
And here it is, laid out side by side. The Federal Reserve, worried about jobs, has decided to cut its main interest rate by 0.25%. Their focus has clearly shifted to protecting employment. The ECB, on the other hand, nope. They're holding rates steady, keeping their eyes locked on that inflation target. And this divergence is a huge deal, by the way. It has immediate effects, especially for currency markets, and could easily push the euro higher against a dollar that's being weakened by lower rates.
Let's just dig into the Fed's thinking for a second. This statement says it all. For them, the balance of risks has shifted. What that really means in plain English is that they now think the danger of a weak job market is a bigger threat than the danger of inflation staying a little too high for a little while longer. It's a calculated gamble that it's time to ease off the brakes and give the economy some support.
So, with the two giants of the financial world walking in opposite directions, what happens now? Well, the answer is pretty simple. It all comes down to the data. Every single economic report that comes out from now on is going to be put under a microscope looking for clues about which central bank made the right call.
And as this table from investing.com shows, we are not going to have to wait long at all. This week is absolutely packed with critical data. On November 5th, we're getting two massive reads on the US labor market. The JOLTS report, which tells us how many jobs are open, and the ADP report, which tracks hiring in the private sector. These numbers are going to be the first major test of the Fed's decision, and trust me, everyone from Wall Street to Washington will be watching.
And that leaves us with this final, crucial question. The Fed is betting it needs to support growth, while the ECB is betting it needs to stand firm against inflation. One is hitting the accelerator, the other is keeping a foot on the brake. Only time, and of course the data, will tell us which of them chose the right path. Thanks for watching. Don't forget to like and subscribe.